Hello, this is Angus Murray, Castlestone Management. I thought I'd give you a brief overview in 10 slides of our current comments on the market. The first slide is one that I'm sure you have all seen before, the overview of the psychological market cycle. I think that it indicates, again, very clearly that people should be or should have already been buying into equities. And I think within this cycle period of where we are at the moment, that we would be past what I would call, or we can see the depression stage there on the right-hand side. Slide 2, you can see that, and I come to that conclusion because clearly the fear with regard to the impact of COVID-19 is not going to get out of control. We can see that across the various countries, and you can see the impact that China has had, even if those numbers are not 100% true. But there is clearly a peak with regard to the infection rates and the death rates, as sad as that is. But it does lead to a degree of optimism that countries and the world can overcome this ultimate problem. In slide 3, we see the performance of the S&P 500 since 1973. The fact that every time we get a market decline and eventually a recovery, I think is critically important here. And that is what we are already beginning to see. Remember that markets trade on expectations, and obviously the realization of the severity of COVID-19 was factored into the market very quickly, and we are now beginning to see that recovery. Even if the actual economic recovery takes longer than we are all hoping or is currently expected, the market in itself is likely to recover faster. And that is connected to a slide which is number 8, which I will show you in a moment, in the fact that the 10-year bond virtually gives no yield. It is yielding under 1% as it is around the rest of the world. And that lack of return you are getting in cash or in bonds makes equities significantly more attractive, particularly in the fact that you are getting a yield of over 2% in the S&P 500. Slide 4 shows us the inflows that we are getting into technology, in this case the Vanguard Technology ETF at the moment. And that's not surprising if you consider what I'm about to show you with regard to our increased use of technology, be it Microsoft Teams, like we are using ourselves every week now, if not every couple of days, and of course the number of people who are using or signing up to Netflix, another form of technology which is definitely benefiting, let alone the number of items that we are buying on Amazon. Slide 5 just shows you what is actually occurring up to the week of April 26 with regard to some exchange-traded funds. And that is that technology has seen inflows of $1.3 billion. Yet overall, US equities had outflows, net outflows of $6 billion. I would indicate that it's very much the wrong time to be taking money out of US equities. That happened very quickly in terms of the decline. Once in that position, you should really have only been allocating more towards equities. But of course, that $10 billion now will be sitting on cash and getting no return. When people see the market continue to rise or stabilize, they will be most likely returning those net outflows back into the market, and technology stocks will continue to be a beneficiary of that. Of course, even if they return the $6 billion just back into an S&P 500 fund, given the weighting of technology in the S&P is 20%, they will be buying $20 worth of technology stocks for every $100 that they are investing. The inflows will continue into technology stocks. And as I said previously, and this is on slide 6 and 7, we can see why technology is becoming of greater use to us. And we see that with regard to Netflix. And as you're aware, Netflix in the first quarter of this year added 15.8 million customers. It had never added more than 10 million customers in a single quarter, and let alone the additional numbers of people that they could be adding in Asia and South America to continue to grow their overall business. Microsoft Teams, well, there's been a dramatic increase in the number of people using Microsoft. And I think that it shows you the greater degree of penetration that technology is having in our lives. And as I mentioned to you, I wouldn't be surprised if everybody hasn't used Amazon in the last week or so. Slide 8 shows the yield on the 10-year bond. And why this is critically important is because leaving your money in cash or in bonds no longer gives you an adequate return. And as a result of that, it compels people, pushes people into buying equities. You get a higher yield and a prospect of a positive return, whereas after inflation, buying the 10-year bond in the United States, you are almost guaranteed to lose money. The last two slides just relate with regard to performance. So slide number 9, you can see our white line, FANG plus UCIT fund, and then you can see the purple line, the NYSE FANG plus index. And you can see the great similarity between our fund and that particular index. It just means that our fund is obviously doing exactly what you would expect it to do, and it holds exactly what you expected to hold. Slide 10, the final one, just takes a look at that from a slightly longer term perspective. The main difference between our fund, FANG Plus, and the NYSE FANG Plus index is that we are not allowed to be as concentrated as that index. We had moved our weightings back in the middle of March to be as close to that index as we could with regard to our weightings, but we are limited by, restricted by EU rules in terms of diversification within our fund. But that movement that we actively made towards being more like that index is probably the reason you are seeing us pull away in terms of performance above the other funds that we are showing on that particular slide. If you need further information, by all means, please contact our sales staff. Thank you.